Thanks for joining us for this Seattle Angel Conference workshop. We have a great workshop today with Steve Hord talking about how to get ready for taking an outside investment. This is part of a regular series that we're doing. So every Tuesday and some Thursdays, we're doing workshops. I hope you'll look at the meetup group and explore those. Our effort is to try to get going in September, first week of September, investors and 50 companies, which we will eventually write a $200,000 check to one of those companies. So if you want to know about that, several of the participants tonight are members of the Angel Group and have written checks before and can tell you about that process. So we'll have presentation time. We'll have a Q&A time. When we're doing the Q&A, just raise your hand and we'll bring you up to the stage and you can go. There's a chat room on the bottom. So if you have questions along the way, feel free to write in the chat and we'll try and talk about that a little bit. And if you, when we get back to mingling at the end, if you would make sure to visit a bunch of tables, I think it'll be a great way for you to find out more about our startup ecosystem. Let me bring Steve up on stage. Steve, could you click on your mic and camera, please? There we go. So Steve, you are very active in our angel investing for a while. I really appreciate that you're engaging in this. You want to give people a little bit of background about how you got to angel investing?
Yeah, I'll just give a little bit of background about myself. So I came up in the Seattle tech community, originally working for Aldus and Adobe. So that sort of slightly dates me a little bit sort of to the mid 90s. Somewhere in the late 90s, I got hooked on the sort of the startup bug. And I joined several startups either as an early employee or as a co-founder, and worked my way through pretty much every function there is at a startup, from 0 people up through about 120 or so, and eventually led a company called UB Matrix to an exit as the CTO in the about 2012 timeframe, something like that. I've been involved in at sort of after that or post to that a little bit. I've done some work with Madrona Ventures from time to time as their lab projects basically, and most recently in the last 4 or 5 years, I really sort of picked up and my emphasis more on sort of the angel investment side, and with sort of the goal of two goals. One is to be a really early I feel like I bring the most skills, the most input towards that first or second check, and really as both an investor and an advisor for some of the first rounds. And that's my interest. So I think John and I have talked from time to time about my sort of investment thesis, and I think everybody should definitely have an investment thesis for sure in this group if you're on the investment side. And as a entrepreneur, you should really ask people what their investment thesis is, because it will shorten the conversation sometimes. And I think John knows that I really like sort of big ideas, and I really like a great team. So probably more than anything else, show me that you've got a broad sort of ability to think big, and show me a really great team with a proven ability to execute and a proven ability to stay focused. And I'll invest in the team as much as I will any one particular market or any given idea. So hope that helps folks a little bit.
So you want to try to set your screen up so that we're doing screen sharing, and then I'll drop off and you can keep on rolling.
Yeah, all right. So how's that? Can everybody see that? John,
just coming up. There we go. Can you give us the slides so we can post them in the meetup group?
Yeah, I will. So do you want them right now, or do you want me after the end of the show?
Okay. Right. So thanks very much, Steve.
Great. Okay, so this is going to be a little weird because normally I would have feedback from everybody. So if you have questions, post them in the chat. I'm going to cover maybe 15 minutes, maybe 20 minutes of sort of the highlights of this. And then what I think is really one sort of truism is that every case in due diligence is a little bit different. Every company will have some things are really common, but your individual way you present your company will be a little bit different. And I think one of the best things to do is to sort of very much try to make it question and answer oriented. And you can ask either about your own company if you want to, or another company that you've seen recently. And we can sort of I can give you my opinion both. I'll try to give you my opinion both how I would handle it as an entrepreneur, and I'll try to give you my opinion about how I would handle it on the investor side. And so with that in mind, I really just have maybe 5 or 6 slides that I want to cover, plus a few financials that we should cover. And then the rest of it, I think we'll try to do just in question and answer. So I'm going to see how this works. I don't know if I can just jump through this real quick. So do you guys see that? Can somebody give me a thumbs up if they see me sliding through going through the slides?
They are working
here. So okay, cool. Sorry, just as I was sitting down in my awesome location here, the sun decided to set in a weird way. So I'm going to move just a little bit. Okay. So I think there's some things that we have to get out of the way right away, right? And I'm going to cover a couple items here, which is the first thing is sort of general corporate information. So you'll be shocked really at how many people haven't done this before they get into a due diligence scenario. And I mean, I don't really want to spend time on this as an investor. I really want you guys to come in with a package ready, and I need to check off a few boxes here. And I think the thing, or my advice about this, is that really as an entrepreneur doing due diligence, you just don't want to spend time here, because there's nothing that you're going to do here that is advantageous to you. So basically you don't want to get a strike here with either corporate due diligence, either corporate information or company overview or team items. And so let me cover what this means. So the corporate information stuff is all of your corporate registration, and you should have basically a C Corp. We have some discussion about whether LLCs are okay, but I think in general, for the most part, I think everybody here should have a C Corp if you expect to raise any significant amount of money. I think John and I can talk about why sometimes we won't invest in LLCs later, but I think everybody should know that by this point. Should have all your incorporated, and really all of your key docs around. Oh, there you go. So John says he won't do it anyway. And I have one that I've done that was an LLC, and they'll eventually be a C Corp. So basically, I think the gist of this is I don't want to have you explain to me a weird corporate structure, right? I'm not interested in being clever here. I'm really interested in being boring at this point. Same thing for company overview and the team. I don't really want to have to bug you or chase down for resumes for the team or any of your corporate detail or any of your corporate docs. The one thing that I'll look at out of here, and I think I have this in another slide, for sure you should have, and you should have a good story for this, is what your team is and what your cap table looks like. So I'm going to just assume, since I can't ask the question, that everybody knows what a cap table is. I think there are, again, this is one of the places where you don't want to get a strike here. So you can think of due diligence as sort of 3 strikes and you're out kind of model. It's really actually more like 2 strikes and you're out. Don't waste a strike on something like not having a right corporate structure or not having a well understood cap table. So pitfalls that will get you a strike, basically. Having somebody on the cap table who doesn't currently work for the corporation, meaning the ex-wife of some founder who left 2 years ago, he or she really isn't involved in the corporation anymore. They're not involved in the business. They're not adding value at this point. As an investor, I really just don't want to share my investment with them at this point. So That's a pitfall. You should have a basically really clean cap table. And I like to see people really involved in the business. So your executive team, ideally, by the time you even get to a SAC round, we should know at least 3 of your key executives. So you should have a founder, co-founder, and a CTO, or a founder, co-founder, and a director of sales, whatever, or a VP of sales, whatever. You're usually going to have 3, sometimes 4 or 5 people, but 2 or 3 at least. We should know what their cap table is, what their responsibilities are on the cap table, what their line item is on the cap table, and we should really know. Excuse me, and we should really know what money is set aside for the rest of the company. So you may have placeholders, and that's fine. I understand that not every position may be filled yet, but we should know what the basic capital distributions are going to look like. And people ask sometimes, what the amounts should be. I think as an investor, I don't look for anything specific. There's no hard rule that says, the CTO has to have 10% and the VP of this sales has to have 12% or something like that. But what we don't want to see are weird numbers here. So we don't want to see a CTO with like 1.5% of the company, right? Not at this stage, not the stage that we're going to invest in. We want him to be, him or her to be, really invested in the company and really involved. So, and same thing, we don't want to see a founder who keeps 98% of the company for himself and doesn't want to share with other folks, or isn't going to attract the kind of talent, or isn't going to have the kind of budget that's going to attract the kind of talent that you need to get a company started. So typically what we'll see is 3 founders. I like to see a nice even 33% across the board for everybody, with an understanding that that will get diluted for future investors. It'll also get diluted for an employee pool. Some people ask how big the employee pool should be. Again, there's no hard and set answer, but I usually see numbers between 15 and maybe as high as 25%. A lot of companies recently have settled on 18% as being as being sort of a kind of an okay number there. But again, I don't think it's any. Thanks, John. John likes someone to be in charge, and I'll point that out. So one issue that can happen with cap tables is sometimes we'll see a cap table where it's 20 20 20 for 3 founders, and then the remaining split across future employees and future investors. That's, in my book, that can be okay in certain circumstances, but doesn't give clear leadership responsibilities to the CEO and the original founder. I think there's no for me, there's no hard number here. There's no absolute number, but the number should match the story. So for instance, if you have 3 founders who equally came up with the idea and we're going to share ownership equally, that might be great, but one founder might be the designated tiebreaker, and that's something that actually might even be in the corporate information that's available. So you can tell a story around that as long as you have somebody who can who's trusted to make the final decision if there's a tie, right? So the issue would be, well, if you only have 20% and everybody else only has 20%, you have to make a decision about funding and there's a disagreement about it. You may need somebody who has 21% or something like that to make a tie decision. So not a deal breaker for me, but some investors do consider it super important. So come with this stuff pretty well established. I want to look at it. We may have questions about it, and I certainly want to meet everybody. What I don't want to do is have to either sort of bug you for it, or what I don't really want to do is find out that something's wrong. So you can expect that I'll get everybody's resume and I'm going to compare it to their LinkedIn profile and I'm going to call references on them. And it should be accurate and up to date. And I think that's relatively easy to do. So while this stuff's important, please have it ready to go before you show up. So, and I guess normally I'd ask questions about this. Does anybody want to post a question? I'll answer it directly, or we'll, I can jump, John, to the next slide, and we can go through my slides initially, and then do questions at the end if you want.
No, I think it's fine for you to have that rhythm. If anybody has a question, just raise your hand. We'll bring you up to stage and you can ask the question and make it go. So I'll be watching the participants channel. Just click on the raise hand thing and we'll bring you up. So I see Michelle has a question. So I reach over here and I grab her and I say, yes, put her on stage. That should bring her up. If she turns on her mic and camera. Yep.
Is it on?
That's pretty cool.
Yeah, we're good.
You're on.
Stephen, my question is about the resumes. This is my first time hearing a lot of this. Who exactly are we looking for? Our resumes, our employees' resumes, or everybody?
Yeah. So honestly, if you have less than 10 people, I would have everybody's resumes, right? Because I mean, you are selling your team, right? And you're really focused on two things here. One is the team itself, and you're really pushing your underlying ability to recruit and retain talent. I talk about this with founders often. This is something that you are actually selling me. You're actually selling me not only that you have this great product, not only that you have this great financial plan, not only that you are going to be able to execute it, but that you can get the right talent on board when you need it. And a lot of startups get to the point where they need to make a really great key hire, for a really great sales guy or a really great engineer, right? And either they can't do it or they haven't really realized what it takes to do that. And so, I look at that as something that is a key factor in my decision about whether or not I'm going to back the entrepreneur, right? And so bringing great resumes to the table, both for your C-suite executives, so, however you have your company laid out. If you have less than 8 or 10 people, I would bring everybody. Honestly, there's no hard rule here. I would bring as many good resumes as you have. I don't need to see a resume for, if you have 25 people, I don't need to see a resume for an individual contributor, on the engineering team, or an individual contributor, on a sales team or something like that. But for sure, the executives.
Like production help, because we have a, chocolate. So somebody that's making the chocolate, maybe not necessarily, but the rest of the team. Okay.
Yeah. Anybody who has a director title, anybody who has anybody, and certainly at a very minimum, everybody who's on the cap table as an employee, right? So
thank you.
All right.
I don't know how to lead.
Yep.
I'll take you off.
Thank you.
Any other questions?
Jacob, I would. Yeah, so I see Jacob asking about resumes for advisors. Yes, resumes and contact information for advisors, because, for sure, because we want to reach out, right? I want to hear their feedback. So
John seems to have a question.
Yeah, so do you include resumes for contractors? We've got 4 people that are significant contractors. They're not on the cap table, and they're not, but they're doing a lot of work. Where is that balance?
Yeah, so I think I talk about this in the sense of that, these are some general guidelines. Every company is a little bit different. Are you selling me partially? What are you selling me, right? And are you selling me your ability to execute against your plan, right? And if some of what you're selling me is, hey, this product, right? Let's pretend it's a SaaS product, right? It's a software SaaS product we're going to deliver, right? One of my biggest questions always is, can you get a tech team? Have you been hiring in the Seattle market or the Mumbai market or whatever, right? Show me evidence that you're going to be able to hire to execute against your plan, because I'm in the hiring market all the time and it's brutal out there, right? And so if you have part of what your sales pitch is, hey, I've already executed to this level, right? And here's my team that I've built, then bring the resumes, tell the story that you've done a great job, right?
Because that definitely, I'm a one-person show right now, but I've got a team of 5 different contractors doing a heck of a lot of work, and I don't know how to marry that.
Yeah, so that's part of your story. So without a doubt, part of your story is we'll talk about this a little bit. We have a division and all the things we want to do, right? But execution, and this is part of the execution story, right? So,
which is also suggests that there's some C-suite people that you haven't yet hired that you need to think out, that at least need to be blocked out, if not actually in motion.
Yes. Yep.
Okay, I'll move you off.
Thank you very much.
I think, Kate, the answer for that is, are they relevant to what you're doing? So, if you have an intern who happens to be filling the role of CTO right now, then yes. But if you have an intern who's just handling order management or something like that, then probably no.
So I see that Ree had a question. Let me bring her up.
Hello. So my question is, if you're a CPG company, is it critical for it to be a C Corp? Because if the company were to be liquidated, there's going to be a lot of physical assets, a little different from, let's say, a tech company or a SaaS platform.
Boy, yeah, I mean, there might be some weird exceptions to this rule about being C Corps, but I think in general, the answer is going to be yes. So fundamentally, one of the issues is that if you're an LLC and we invest and if we either SAC or myself individually, and you add us, essentially we become part of your cap table at that point. We also potentially take liability on for any debts that you've incurred, right? So there's a lot of hesitation for myself to put my name on a cap table of, to own units, basically, right, of an LLC. So I think the answer to that is yes. And there may be very limited exceptions to that.
The biggest issue for me is that an LLC is a pass-through entity. And so whatever you earn, I owe taxes on, and whatever losses you have, I get benefits from, because it all passes to my personal taxes. So in the world of no surprises, a C Corp sort of builds a wall and we don't get surprised. Mm-hmm. But with an LLC, there can be many different paths to us getting surprised. And the last thing we want is the need to come up with an extra $10,000 in tax payments because all of a sudden you made a lot of money last quarter and you didn't tell us about it.
Yes.
Yeah. Anything else?
No, that's it.
Okay, so I'll take you off the screen. I see that John has a question about resumes and LinkedIn. You want to address that?
I think that's fine. Don't make me chase the links. Like, don't make me do work that you can do for me, right? There's a little bit of if you just print them out or PDF them and put them in your diligence package, that'd be great. But yeah, I think a LinkedIn profile generally is fine for resume.
Can you talk a little bit about how you like to get the documents? A little bit, would you like a stream of emails, 400 emails with an attachment to each one?
No. So I think as John knows, and I'll show it if we want to, or we can jump to another slide. How about I'll just show the due diligence framework for SAC real quick.
That'd be great.
Let me bring that one up. So now I've done share screen. I want to change tabs. So how does that work? Yeah, here we go. Can you guys see this pretty well? I'm not going to cover the whole thing, but this is one of the framework documents that a lot of folks from SAC
It's a really, really,
I think John will share it for you. Oh, is it just too small to see?
Hit the Control Plus.
Does that help a little bit?
See if you can get it bigger. Yeah, that's
a couple
better.
Times. Okay.
Yep.
How's that? If I just zoom in a little more, even. Okay, so we won't be able to see this whole thing, and I don't want to go through it. It's 10 or 12 pages, but we will cover sort of some of the highlights of this. So generally speaking, for myself, and I think this is true of most groups, it is usually you'll be working with an angel group of some kind. You may work with an individual, but for myself, I usually invest either with SAC or with Grubsticks or one of the other groups around town. So we will put together basically sort of a deal room, and a deal room can be just as simple as a Google Docs folder. And I don't know if I have an example of this, but typically people organize them pretty well with subfolders. So you'll have corporate information subfolder, you'll have a resume subfolder, you'll have a financial subfolder, you'll have, if you have a product examples or product, you know, if you have screenshots from your product, if it's a software product, or if you have, you know, pictures of your products, if it's not a software product, typically, you know, even that kind of level of detail is not uncommon. And if we look, I can sort of scroll through this real quick, and John can share it. Here's sort of an example of some of the things that would be there, right? So all of the corporate information, again, company overview, team. So here's some of the examples of some of the items that we might look for in team. So I like to have at least one member of the team have prior experience with startups, but it's not required. But you know, I like to see that kind of stuff. So this is, and I'm just going to kind of buzz through it real quick, so you can get an idea of kind of what's in this. When we fill one of these out, you can expect this to be 15 to 20 pages by the time we're done with the whole thing. So come prepared to answer, you know, a lot of questions basically. And I'll touch on the higher sections as we go. So I'm not going to dive into some of these because I'm going to dive into them a little bit deeper in a minute. I think why don't we jump to the next slide, John? Let me see if I can do this right. Okay. Okay. So we started out with some of what I thought was some of the boring stuff. And for me, and some of these, I'm just going to say, this is, you know, we all bring our biases, and these are some of the biases that I bring. These are not the only biases. And some other angel investors will focus on different things. But my next most important thing that I look for is product and product market fit. So I want a great discussion of what the product is, and I want a great discussion of who is buying the product. And really, I mean, there's nothing better reference than a customer reference. So a lot of startups, even at our early stage, will have had, if not a paying customer, at least beta customers who may not quite be paying yet, but they're close to paying. If you have that in your product or in your due diligence package, that is something that you should probably always consider leading you know, your story with, right? In other words, you know, we have signed up X number of customers. This many customers gave us, you know, 5 stars. This many customers we re-sign. If you have a recurrent, we always love to see how many people re-signed up, you know, after their trial period expired, that kind of stuff. So I have a real emphasis on the product, the market, that there's product market fit, and that there's customer references. The next thing I always look for is moat and what we'll call competitive advantage. So have a great story for what the competitive advantage that you bring is. So this is really, I think a lot of small companies, we make or break at this point. So even at a young company, right? Even a company with maybe only, you know, a few employees and just maybe a few sales, we will have a good sense whether or not you have a reproducible product that somebody else can do quickly and easily, or whether you have something that's really unique, and you'll be able to sort of defend your sales once you've made them, right? You won't have folks, you know, able to steal your customers away from you. And then the next piece that I like to do, and this is because I have a technical background, so not every angel will go as deep into this as I will go into it, but really the technology and the product assessment. So I do like to spend time with your technology team or your CTO or, you know, your VP of engineering. And some of us in the Seattle community, since a lot of us were software engineers at some point, will dive deep. And I'm not going to do a code review or anything scary like that, but I want to see more than just the working product. I want to know what the architecture, what the deployments look like, what the cost of deployments look like, what the cost of deploying the product looks like. So I have in mind, again, John, doing questions based on this, if that's all right with everybody. I think there's a lot sort of unpack here. And again, I think every case situation's a little bit different. So help me ask your questions.
Yeah,
about
so
your
if you have a
specific company.
question, raise your hand and I'll bring you on stage. No hands up.
Oh, there's a lot there. There's a lot there.
So while people are
So-
talking about it, when I have specific things that I think of when you say product market fit. What do you mean when you say product market fit?
Yeah. So obviously, at this point, you may not have hundreds of customers. You may not even have dozens of customers. But I want a good narrative discussion of who your product is and who benefits from your product, and then some analysis of whether or not that market really exists, right? So sometimes we talk about having a sizing, what's the available addressable market? So the TAM, right? TAM is the term that's used a lot, the total addressable market. But really having evidence that there's desire from your customers for the product is what is going to be the tipping stone here. So the tipping piece. So what happens is you can have a thesis, and there's lots of companies at the early stage that will still just have a thesis. We think this product will be really successful if we make it, basically, right? We think product X will satisfy a problem the product that exists in a marketplace. But showing evidence for that is the difference a lot of times between getting funding and not getting funding. So at the early stage, if you're pre-seed or if you're not pre-seed, if you're even pre-angel investment, right, you may only have $50,000 to spend. I always try to get people to find a way to prove that there's customers want your product, to prove that customers, not just that they're willing to use your product, but they're willing to actually pay for your product. Because at this point, where we're looking at making, maybe a $250,000 investment, that is one of the biggest things you can bring to the table.
So you use the word evidence and you use the word traction. I brought Danny Lowe up so that he can ask in more detail some of those analytical things around product market fit.
How do you sometimes also measure, let's say your idea is, let's say it's vast, it's big, and it's hard to develop in product market fit. And do you value more of a customer review or potential customer review from like a high level company or an executive that say, hey, I think this would work for me and my services, and kind of get see a commitment as a product market fit there? Or would you directly want to see kind of metrics like TAM and I guess?
Right. Yeah. So this is why this is so, what's hard about doing this is that you try to say, I want to give this broad answer of what due diligence is, right? But clearly due diligence for a consumer product, especially like, we did due diligence about a year ago for a consumer electronic deliverable product, right? So, a video product basically, right? They can get customers, on their first day of being in operations, right? Or first week, right? So obviously we're going to have a different approach with them than we are going to be an enterprise SaaS product that might take 2 years to develop the product before the first sale is made, right? So you have to address this a little bit differently for each use case. But evidence talks, basically, right? So you're telling a story as an entrepreneur. You're saying, I have this thesis that I can build $1 billion company to solve this problem, right? And we say, hey, we really like you. We think you're really smart. What evidence is there that this marketplace exists, and what evidence is there that this product will be, will satisfy the need of the marketplace? So really, if it's ideally sales, right? If it's the right kind of product, it's a sales example. If it's not sales, it's customers that are willing to pay for a beta, customers that have said, if you bring me a senior, a C-suite exec of a Fortune 500 who says, my sales team has been demanding a solution to this problem for the last 2 years and we haven't found one yet, and this guy's got a solution we think is going to work, I'm going to take that as evidence, right?
But some of us are a little bit more pedantic about it, and we think that customers are people that spend money, and if you haven't proved that a customer will spend money with you, then that's less valuable, right? So that letter of intent from random company XYZ is way less valuable than that paid beta or that payments to do consulting for you on the topic even are better in my mind than the letter of intent.
Yeah. So I will say that I have sat through due diligence with SaaS companies for which only have a free product. They have a free tier and a paid tier, right? And they haven't activated their paid tier yet. And we chose not to invest because they hadn't activated their paid tier yet. And while there was traction for the free tier, right? They had thousands of people at the free tier. None of us were convinced that they would convert at the rate that they claim, that would be necessary basically for them to be a viable business at the paid tier. So there's a lot of weight, John's right. There's a lot of weight put behind paying customers, even if it's a paid beta, basically any way you can get someone, it's good for two reasons, right? It shows revenue, right? So, but also, it shows customer commitment in a way which free doesn't quite show the same commitment. Basically.
And it also gives you specific measurement of critical conversion rates in your financial model that will make or break whether or not you're actually a business.
Yep.
Anything else, Danilo?
I heard a subtle, I heard a subtle, I will not invest in social media companies. Is that what I got from that last answer?
No, I mean, I actually have an investment in something that's sort of almost like a social media company. I mean, it's not, but it has some of the attributes of a social media company in that it needed to get very large before it could be successful, right? Scale was going to be required. But no, I mean, for any traditional SaaS, so for the stuff that we see a lot of, like, anything that's sort of a SaaS B2B, any B2C that is sort of electronic delivery, any sort of electronic products, any app type development products, you can in fact test those with paying customers much earlier than you think you can. You do not need a full product to test to see you should know what your core value proposition is, and you don't need a full product to test that core value proposition. And I will encourage you to test the core value proposition. Honestly, before you even come to SAC, before you show up at a SAC, you should have some of these things worked out already.
So Jacob is asking how many pieces of info, and I want to sort of stick my nose in. There are two numbers that I think are really useful to anchor these things. One is, what's your revenue? How does that work? Prove that the revenue works. The other is the change in revenue, growth in revenue over time. And so if you have those two numbers and are managing to those, what do you think, Steve?
Yeah, so I mean, I think, again, I think it depends. Businesses that rely on recurring revenue, and so and sometimes it's too early when you come into SAC. You don't know what your retention rates are going to be, but the sooner you can answer those questions, the sooner you can kind of get past the objections that some of the investors are going to have. So at a very minimum, knowing what your price point is and having evidence that the market will support that price point is probably some sales at a certain price point is probably the minimum amount of information that you want to have. And then the more you can show how fast you can make sales and the cost of making those sales, the more data is better. Basically.
I see that Yashar is asking, what kinds of verticals do you care about?
Is that a question for me personally, or is that a broad question?
I'm not sure what Yashar is asking. So, personal.
Gosh, I have a pretty broad, I like to see big market opportunities. So financial services for sure. So a variety of
What do you mean by big? 50 million, 5 billion?
Yeah, I have to sort of divide by 10, right? So this is just one of my overall experiences. If the TAM isn't at least probably 5 or 10 billion, then your ability to get in and make a meaningful company, you're not. It's unlikely that you're going to create a business that is the only player in a $5 or $10 billion market, right? So you're not going to have a monopoly. In all likelihood, there are very few really innovative businesses where there's like no competition, because it's probably not a business if there's no competition. So I like to see a business where the total size of the market is at least 5 or 10 billion, or we think the total size is at least 5 or 10 billion. And then I feel like, hey, if you can get a 10 or 12 or 15% market share of that business, over the time it takes to develop that, might take 10 years to develop that market share. We have a really good, strong business at that point. So that's one of my sort of driving factors. I actually a little bit get scared away from people who think that they have $100 billion business, right? Sort of a social media kind of thing, because I have a very difficult time judging that. So that's just a personal limitation for me. If you come tell me you're going to take over all of financial services for student loans or something, I think that's already a really large business that's pretty well understood. So, I have questions about how you're going to do that exactly. But I don't want to hear it. I'm going to have a lot of extra questions. So that's just me personally.
I see Christopher is asking about the tech and product assessment. Is there any immediate red flags that you watch out for?
Yeah, so there have been some red flags that we've seen actually, which is things like key developer not on the cap table and not part of the company, right? So contracted developer who's super important to the organization. So that can be the CTO is moonlighting basically, or hasn't quit his job yet. So those kinds of things where basically the key technical personnel are not fully attached or not fully committed to the company. It is actually fine to outsource your development. And lots of companies have done that successfully. In fact, companies I've invested in have done that successfully. But then you should demonstrate that you have somebody in the company who can manage that process. It's a little bit of a unique process. And so that's also fine. But we have sunk deals at SAC and other deals I've seen we've declined or not been inclined to invest. Principally because somebody who was presented as the CTO was still working at Microsoft, basically, or still working at Amazon, and we felt like that was too big a risk, right? So there you go.
You want to go on to the next slide?
Yeah, so I've got 2 more slides, and then we'll look at some actual financials and some stuff like that. So let me jump to the next slide here real quick. Oops, let's see here. All right. Oh yeah. So my favorite. So this is one whole slide for just one important word here. So the economics. So we've gotten through who you are as a company. We've gotten through a little bit of discussion about who you're, presumably before we get to due diligence, we already know what your product is all about. We've established that there's hopefully some product market fit, that you have a team, and that we haven't done something with the cap table. And now we're going to get down to sort of what we'll sort of it's both the easy part and the hard part, which is how to tell your economic story. And this is where having some financial models will be part of this. But for myself, I always start with the basic unit economics. And I can't tell you how many times somebody's thrown up the hockey stick with all these kind of great sales projections and all this, all this great story about the billions of dollars in market size that we're going to see. But when we get down to it, the entrepreneur doesn't know their unit economics, flat, cold, no discussion about it, and no wiggle room about it. You have to come to this, and I don't really care what kind of product you have. If this is a SaaS product, if this is a consumer deliverable product, packaged good, if you're a retail store, if you're a pizza shop, if you're an app that, I don't know what they do, harvests data for sale on some dark marketplace somewhere, right? I need to know what your cost of good, what you're going to sell the product for, what your cost of goods are going to be, and what it costs you to add one more new customer. And you need to have a spreadsheet that describes this in detail. And don't necessarily worried about getting it perfect, but we need to know that at the unit level, you can make money on a transaction. I understand, and we understand that you may not make money on your first transaction, right? You may not even make money on your 500th or 1,000th or 10,000th transaction, but we need to see a path towards unit profitability at the unit economics level. This is a big topic, so I definitely want to just stop right here and answer questions about this. This sinks deals probably more than anything else I've seen.
So not everyone gets what unit economics are, and not everybody gets what the difference between basic bottom-up cost is and the fully distributed cost the company is. So can you dive into that a little bit while they're thinking about things?
Yeah. So do you think it makes sense to look at financial projection while we're doing this, or do you think I should just talk about it? I'll just talk about it for a second. So so the unit economics really are what you sell your product for minus what it costs to make the product minus what it costs to market and sell the product. What does it cost you to build, create, sell, distribute an individual widget, whatever it is you make, right? And so what that can be, 1 minute of video time, that can be a certain amount of time on a game, that can be a certain amount of a consumer package good, that can be a pair of shoes, and we want to know very specifically what the cost of delivering that good is to the customer, and what the let's see what am I missing here? I'm forgetting. And what the cost of selling that is. And this becomes the core of your financial projections. So eventually, there's economies of scale and things like that you can build into a set of detailed financial projections, which you can create later. But unless you can defend this most basic of numbers, we won't get to the more sophisticated analysis that comes later.
So what happens when I build a thing and I need to be selling it to a wider audience, and so I start using distributors?
Yeah, so margin can come down, right? And so we want to model for that, and we expect that to be in your cost of sales, basically. And we will point that out if you come and you don't have distribution costs, or you don't have the cost of sales. I mean, I've seen models that have no sale, that don't have proper bonus structure for the sales team, right? Where they just forgot that they were going to probably have to pay their sales guys, right? And so what happens is, like I said at the beginning of this, you're allowed a couple of strikes, right? Most experienced due diligence in your due diligence package. That's okay, right? I mean, at this level, not only is nobody perfect, but you may be building this for us for the very first time you're building this for anybody, right? So you get some amount of do-overs, right? But there's a couple of places that you don't really want to spend your do-over money, right? You don't want to spend your do-over coin. One of them is on the basic economics. One of them is on the basic structure of your company, and one of them is on the unit economics. Have this stuff down cold.
So,
any other questions about that?
We have a video from Carly Price that is not on our YouTube channel yet. I'll try and go get it. But here's one that she did at Commotion that does the Startup Financials 101 that sort of covers the basics of that. And so I posted that in. And I see that Danilo has put in a graph that might be helpful. I see that Jacob asked the question, is there a minimum or range for gross margin that you expect at a unit level?
Yeah, I mean, early on, before you have achieved any sort of scale, we need to know what they are, and we need to know that you can manage the process of sort of getting to scale. The The answer to that is no. It's going to depend a lot on the characteristics of the market. So there are some markets where they're very, low volume, very high, very high margin products, and there's some markets that are very, high volume, low margin products. We will recognize a situation. If you have a low volume, low margin product, you probably will have trouble getting an investor, right? If you have a high volume, high margin product, we will probably think maybe your numbers aren't right, or that we haven't done enough research on that. It's unlikely that you have a high margin, high volume product that doesn't yet exist in the world. Doesn't mean it doesn't mean it can't, right? I think pharmaceuticals are sometimes examples of that, but it's I think there's an overall rule. Maybe I should talk about this a little bit. I didn't talk about it before. So one of the things that happens in due diligence between myself and the company that I'm reviewing is basically there's a little bit of trying to sort of build trust in the relationship. And this is one of the moments where you have a chance to sort of build trust, which is basically all of the folks who are on the investment side, all of us have a pattern match that we're essentially comfortable with. At some level, we have seen enough companies and been part of enough deals that we understand the rough, broad boundaries of what a successful startup looks like, what the rough metrics of a successful startup looks like. That varies a little bit per industry and per company. So, we're not going to throw something out that's an edge case, just because we don't understand it. But at a most fundamental level, the due diligence process is about building trust with the investors and about staying true to the kind of business that both we want to invest in, but staying true to the kind of business that we think works. And so where a lot of folks aren't successful is when they start trying to tell us, or they start trying to tell the group that, that they've got this, really crazy product that's incredibly highly, they're going to sell billions of, and then they make, a 90% margin on every version of the product, right? Because generally speaking, those products don't really exist in the world. There'll be no other pattern where we can look for that says that company looks just like that other company, except for this one thing is different, or this one innovation has been added. So think about that. Know who your competition is, and know who your adjacents are, and know your relationship. Know what they do in their market, know what their margin is, be able to tell me, hey, we're just like this other shoe company. We have a margin really similar to the industry, maybe slightly better, right, if things are going well, but here's our innovation, right? That's something that I see works quite often. Does that answer that? That's like a non-answer for the question from Jacob, but it's a little bit of what actually happens. All right, so the second part of this was, so the second part of this is building economic projections. And I think probably founders spend a little bit too much time on this. So I think but it's also still really important. And so even if, even if there's sort of the famous hockey stick, which we see basically forever, right? You should actually still have a full set of financial projections that have worked out all of your costs and all of your expenses and all of your revenue projections over the next 5 years. I understand, I think in general, we understand that these are projections. They should be built from your unit economics. You should clearly state what your assumptions are, and we should be able to follow the assumptions through your economic model. So let's see, I have a couple examples of this. I don't know if this is really worth looking at, but I think we can look at it.
I think it's very important that people understand that the assumptions are something we want to see that you are actively testing, because without the test of the assumptions, then you pick random ass numbers out of the air and throw them in there and see, I get a perfect hockey stick, but it doesn't relate to reality at all, right?
Yeah. So I think John's right about this, and I'll reiterate it again. At this level, at the early stage investment, we understand that we're investing in a thesis, right? You probably don't have hundreds of customers paying millions of dollars every year. But what we want to understand is, what are the underlying assumptions around that thesis, and how are we moving through testing that thesis and making adjustments as we go, and eventually coming out with, you know, a known set of quantities. So I'll just give you a quick example here if I can. This is how I like to do it, or how I've seen it done a few times, and I think this works pretty well. Let's see, I'm gonna maybe let's see. Okay, so here's one. So this is from an actual company that I think some folks invested in. I've tried to hide the actual details on it. It's really actually, this is sort of the simple version of this, right? You know, we have some revenue numbers over here. Do you guys see that if I highlight it? We have some expenses, and in this case, it's really just, you know, mostly personnel expenses. You know, we have some nets, but what we have down here is we have the key assumptions broken out. And if you make adjustments to those key assumptions, they're all integrated into the table. So you can see how changing the cost of something, or how you change the revenue from something, actually affects the product, right? And so the thesis around this company really is that they're going to sell something for $40. They're going to net out $21. There's going to have some costs around $30. They end up with a certain amount per, you know, customer per year. And we want to test that and see, is that true? Is that not true? What data do we have that can prove one of these theses, you know, part of this thesis is right or wrong? And in some ways, if you don't have current revenue and it's all just projected revenue, I don't really need to see anything more complicated than this, because I understand, you know, that you're basically making something up at this point, right? But what I really want you to be able to talk in detail to is how you're going to test whether or not this really can work. You have a thesis about what I can sell this product for. I have a thesis about what I can buy, make the product for. I think I know what my cost of goods, what my cost of marketing is going to be, what my cost of sales are going to be, all my other expenses. Let's get to a plan that proves you right or proves you wrong. So yeah, do I need to blow that up a little bit? Can everybody see that? Now, if you're a working business, if you've already got customers and you already have you know, some history. So sometimes we'll see companies will come to SAC, or even to some of the other teams, with 2 or 3 years of operational history. They may not have a lot in sales, but they've been selling some version of their product for a couple of years. You know, then yeah, you know, we want to see actually something that looks more like a full set of, it may not be audited financials, but we want to see something that has more like a full set of traditional financials. And so that might look something like this. Let me see if I can bring this up. And I'll show you where I got this example from, because I think it's a pretty good example.
So basically, they should be doing their P&Ls and stuff out of QuickBooks, right?
Right. Yeah, at least, right? That's kind of the minimum. So I pulled this down a while back from Ernst & Young. Both E&Y and MIT both have sort of example financials for a startup. And let me see if I can share this with you. Let's see. And so this is, you know, a fairly fully built out model with different tabs for cost of goods, a staffing plan, projected expenses. Let's see. Well, I can't get all the tabs, but we will dive into this if you have operations. If you don't have current operations, I may ask, you know, we may ask you to make some projections, but this level of detail, not entirely useful. Any questions on that? And I'll give you the link for this. So this is actually off of, I'm not sure this is the best link to it, but if you want to see a discussion of it, this is off of this site here. And E&Y has a little guide to doing financial models for startups, which I'll put in as well. And they're obviously, both of these are a little bit accounting focused, and We're on the third slide here, or fourth slide of 5. And, I talked really at the early stage about the emphasis on the unit economics. You need to be able to show this document. We're going to ask for it and we're going to want to look at it. But I think entrepreneurs in general probably spend too much time trying to build hockey sticks and build Excel spreadsheets that result in hockey sticks rather than focusing on, some of the, more basics at this level. Later, we go for your Series A or, hopefully a Series B. This becomes the key, this becomes the most important thing we look at. But at this early stage, we need to have it. But again, it's just not, I'm not dying, I'm not going to spend hours and hours and hours asking questions about this. We're going to look at it, make sure you can build an Excel spreadsheet. That's about it. Any questions on this?
One of the things I want to make sure happens is the angel conference is really about angel investors learning how to angel invest. And so for startups, it's okay for them to come in and not quite be where they want to be. And in fact, we have several cases, both Discuss.io and Tribute, which have come in, didn't have some of this stuff, came in again, didn't have some of this stuff, came in, polished it 3-4 times, and then finally won. And so the process of getting all the ducks in a row may take you a little while, and coming into the angel conference early is totally fine as you do that. So does anybody have any economic questions they want to ask? Either raise your hand or post into the chat, please. Okay. So let me ask this question. How many of you have a rolling 13-week cash flow projection? Raise your hand in the participants file. Okay, 1, 2, 3, 4, 5, 6. Okay.
If you're operational, you
this
can
is sort of like
so if you're
mandatory as an operational company. And if you're doing anything in the time of COVID, this is mandatory. Okay, so how many people have a 5-year projection? Raise your hand.
I can't see all the hand raises. Is it just that there's not people raising their hands, or am I looking in
It's
the wrong
over
place
in
for hand raises?
participants, and I see a bunch of people have raised their hand. So that's good that people are doing this. And so down in the guts, these numbers are important. And if you do not have, if your C-suite team does not have these numbers in their head and specifically know what your goals are for the next month and the next quarter, and that there's some commonality to that story, then there's a problem with the communication in the team. And this is one of the places that surfaces a lot. Anybody got questions? Questions, raise your hand.
So again, I want to emphasize that this is another chance for you to sort of build trust. We understand that you are making a projection, right? But make a projection on a reasonable set of assumptions. And generally speaking, we're more interested in testing the assumptions than proving that your projection is right or wrong, or that you've memorized your projection or anything like that.
Can you talk a little bit about, if I'm doing a 5-year projection, right? Those numbers out there are like incredibly fuzzy, but they need to be aligned with some expectation of rounds of funding. And so a hockey stick should have little divots in it that show where the funding happens and where your productivity changes. And if your hockey stick's nice and clean, then you picked random numbers and didn't show me important stuff.
Yeah. So there are some patterns that we'll see, right? So literally, as John mentioned, if you just assume 20 or 30% growth year over year or month over month or something, right? We may have some questions about how you're going to get there, especially often I see magic scaling happening where suddenly there's a claim that we're going to double the amount of revenue we have, but with the same number of salespeople, or double the amount of revenue we have and maintain the margin, basically, right? Or increase the margin even. If you have those in your model, that's okay. You need to call them out as an assumption, right? So we assume that we're going to achieve a certain amount of scaling after a B round because we're going to be able to move the factory, offshore, or we think we're going to be able to get a partnership that's going to help sales in a way that we couldn't get prior to the B round. Have those inflection points in your model. It's not that useful to prove to me that you know how Excel works. What's more interesting is if you can prove to me how a business typically grows.
Right. So some folks are saying 5 years seems a little bit pull it out of the air, but it's still important. Why is it still important?
So in general, you've made a claim about the total size of the market, right? And we want to see if you ran out the numbers perfectly, right? And everything went exactly the way you thought it was going to work. Just how big a business could you actually have? We want to understand, ultimately, that's what you're selling us, right? Or, one of the things you're selling us. One of your things you're selling us is that this is how big an opportunity we think it is, and this is how big, what it's going to take to get to that opportunity. And so we want those things to match up, at the end, right? So, ultimately, we're here to make money, right? We're nice guys. We want to invest and help you and be successful. But at the end of the day, we want to see what would an exit look like if you captured all of the market that you think you're going to be able to capture, and what would the valuation of the company look like? And I'll be honest with you, what can I expect to get back, right? How am I getting my return back?
So are you expecting them to model the exit?
No, I certainly don't expect them to model the exit. It's way, way too early to talk exits. And companies don't generally exit in 5 years. So we don't want that, but we want to see what it takes to get growth. A second part of this, which I didn't talk about, which is in part, you're often selling your ability to manage the process and your ability to, so I talked about it earlier with, can you recruit and retain talent? Part of it is, show me that you have a reasonable and a set of expectations about what it takes to grow a company through 5 years worth of financials, right? So part of that is building credibility here, and so some of this is an opportunity to earn some of that trust, build some of that credibility, not just show me a straight hockey stick and say, well, magic happens, right? Show me that you understand that once you have a product built, you still need a sales team, and it's hard to get a sales team. And show me that you may choose different sales models. So I have another version of this exact same document that shows 2 or 3 different sales models where an entrepreneur came forward and said, I think this is the product. We're going to try a particular direct sales market, and here's what we think the business will look like with a direct sales market. But here's what the business would look like if we pivot to a reseller marketplace. And he wasn't sure if it was better as a direct sale product or through a resellers. Ultimately, it ended up being that resellers, was a faster way for him to get to $1 million in revenue. So it's totally fine. And I think it actually was a good discussion with us. He was very honest and upfront with us and said, I don't know how we're going to sell this. I have to do some experimentation first to determine what the best model is. So he really had 2 models. Well, he had different lines in his model. So it's okay to have open questions. What's not okay is to not understand how those things affect your business.
And so really we're looking for evidence of financial discipline in the core team, and that discipline is being practiced at some level. If I'm a company that's, just getting into revenue, I've got $1,000 a month in revenue, what kind of revenue are we expecting them to have in year 5?
It varies a lot. I certainly want to see good. don't want to answer that question because it's going to vary too much depending on the kind of product that it is, right? There may be companies that I'm willing to invest in that still have relatively small, maybe $1 million or $2 worth of revenue in year 5, if I think that they have a very long product maturity cycle, right? If for some reason they have some, they think they're going to be developing their product for 3 or 4 years and they're only going to be in 2 years of sales after year 5. So they may only have a couple million. But most companies, I expect if they're going to be successful in year 5, are going to have, in the low tens of millions of sales.
And so when we go to a Series A, the Series A VCs are typically saying triple, double, double,
Yep.
right?
Yep.
And so they expect you to be 3x whatever you are when you take your Series A. So then if you work backwards, the earlier you are, the easier it is to do more than 3x, right? So you should be able to be a 10x company year 1, or maybe a 25x company year 1, right? And day 1, maybe you're a 1000x company because you add 10 customers instead of the one that you had, right? And so it gets harder and harder the bigger and bigger you are. But there's some level of expectation of sustained long-term growth. And if you do the exponential math, right, a 10x company, I'm $1,000 a month this year. So next year I'm 10,000 a month. The year after that, I'm 100,000 a month. And that's reasonable early on. And that becomes less and less reasonable the further you go. And somewhere, if you merge the 10x worldview with the triple kind of worldview, somewhere in there is the answer to the question, assuming you start with revenue, right?
Yep. And I think, like I said, every company will be a little bit different. There certainly have been opportunities that I've looked at where, it was a digital product and, it was certainly, no physical barriers to very, very rapid growth. Some costs, right? It costs money to do those, to run ads and get traction there. But there certainly are cases where, I can expect to see very large amount of growth in very early on. There's also cases where, we know it's a difficult sale, right? It's going to be a long sales cycle product. And so, but understand that. I think the most important thing is there may not be an exact right answer here, but there's having the right story and having the right consistency. So if you know that you're going to require resellers once you get to a certain size to penetrate the market, or that you're only going to be a direct sale product, or that you're a consumer sale product or a B2C product, and your limitation is going to be the cost of marketing, basically, right? Understand how those things affect your model and be able to answer questions about them pretty easily. I see a few questions. Yeah, so Bob Crimmins with a good point, right? And I think I was talking about that earlier. I'm a big bottom-up guy, and I think people, different investors will take different approach to this. But I really want to see a straight line from your unit economics through to your full 5-year projections, right? For what for what you think your revenue and your full financial projections are going to look like. I want to be able to go back and understand how you feel like scaling your business is going to change your costs and have that be properly reflected in your unit economics. So
let me bring Jacob up.
So
how's it going?
I want to grab.
What's that?
Ask away.
So I had just 2 questions, and so I was fortunate to attend a Super Angel conference years ago, and so it kind of helps me show the kind of trending and where things are at now. So one of them is, what is the average years of liquidity that you've observed or experienced in angel investments? So previously I heard 11 years, but I don't know if that's just a one person's perspective on it.
Yeah, I think I've heard 8 a lot. John might have a slightly larger sample than I have.
So the great place to get data for this is the Halo report, and it keeps track of all of this. So if you go to Angel Resource ARI, Angel Resource Institute, it has the Halo report each quarter, and it measures those questions. For me, I am seeing on my personal investments that I'm getting a lot of exits in years 10 and 11. And so that's where most of it's happening. And everything that's before year 6 is almost always a loss, right? They either sell early below price or they fail completely. And for the most part, the wins where I'm getting the 10x or 20x returns, that's happening in years 10, 11 kind of deal.
Yeah,
which is what I'm just going to inject one thing, which is one of my warnings to entrepreneurs. You are marrying your co-founders. And I mean, you are going to spend as much time with your co-founders as you do with your family, and pick co-founders that you would like to hang out with for the next 10 years. One of the most important things.
Great advice, by the way. This is my 6th startup, and I've experienced some of that firsthand.
Yeah.
I had one other quick question. Do you ever push for like resetting company valuation? Like if you do subsequent rounds? I know that's common in VCs, but haven't seen it, in some angels.
Yeah, I did participate in a really, really tiny, by down round, it was like a rounding error on the round, right? And it was only because I had previously participated in the company. They had done a seed round essentially, and they did essentially a second seed round, a seed plus round that was at a teeny tiny bit down valuation, but otherwise I would call it flat. And I actually did participate in that because I thought it was still a good opportunity. Pretty rare. That's the only time I've ever done that. I would say you're not going to see that in angel investing.
So
someone will prove me wrong, but it's going to be unusual. So
no, that's really a difference between venture capital activity and angel investing activity. Angel investing activity is usually very, very early. And so a lot of those on valuations are still happening much later, where you have data, where in angel investing, there's not a lot of data to go on. And really it's about relationships and expectations.
Well, thank you.
So I would restate that again. So that I said it earlier, which is that due diligence is an opportunity for you to build trust with your investors. More than anything else, you are selling your vision, your capability to execute on that vision, and you're selling a confidence that you will be able to execute, that you're the right guy, essentially, right, or right person for this marketplace. And from the investor's perspective, there's a certain number of gotchas that we're all kind of aware of and will look for, but really over the long run, and due diligence may run over 2 or 3 or 4 weeks, right? I think the SAC due diligence runs over 4 weeks? I think it runs over 4 weeks. And that's, I think that's probably fairly typical for the angel investments that I've done, kind of anywhere from 2 or 3 weeks to maybe 6 weeks. It's really about very much building trust and building that relationship with your investors. And unfortunately, there's more ways to screw it up than there are to get it right. And that's essentially how companies fail, or how companies fail to get the initial angel investment round, right? So
yeah. I'm going to take you off now. We'll go on to conversation.
Cool. So I actually, was there any more questions about the financials? And I'm going to move inside and grab my battery charger so I don't die here. Pardon me, while the inside the house now.
So anybody have any questions they want to post into the chat?
Was that it on financials? I hope that I covered. It's not possible to cover everything in a presentation, but I hope I covered the area of emphasis.
Yeah, let's go on to the next.
All right, so I really just have one more slide left I want to cover because it's essentially everything else. And how are we doing on time?
Well, you're now a full hour and 20 minutes in.
All right, which is probably too long. So let me do this. Okay, So this is essentially, we've covered what I think is, again, the really important stuff. And this is, again, sort of the list of things that you can, get yourself disqualified with, but for which, with the proper amount of preparation ahead of time, shouldn't be too big an issue. So I have basically traction, scaling, and milestones here, which really is, if you have evidence of traction, please bring it, right? So that's, again, show me who you have as a customer, show me a really great customer reference. One of the things that actually I think really impacted us in a previous investment was a customer or an investor who had a customer who had resold his product to another customer. So he had a customer referral that was so good that he got another customer from that. And so, that kinds of things that show a little bit of that market fit, again, have a package for that. If you have somebody who's willing to talk to us, that's great. So we always want to go out and talk to the customers. And that, again, sort of provides evidence of any traction that you have. Understand what it takes to scale your business. So we talked about that a little bit in terms of the financials, but if you should have a story around scaling. So one of the things, even at this stage of the company, is really, from the angel's perspective, what we're really just trying to do is get you to the next investment round. And so we know that you need a seed round and maybe an A round and hopefully a B and C round, right? And so have a story around what you're going to do to scale, like what kind of issues you may have around your scaling. It's great to have the financial model for it, but also have a narrative around how you're going to scale. So ideally, you're going to take our $250,000 and use that to build out a case for why you need to raise $3 million from a seed round. It's okay. Talk to us about how you're going to spend that $3 million or that $2 million. Understand what your scaling is going to be. Milestones. This is probably more important if you don't already have customers. Show us what your development milestones are going to be. Talk to us a little bit about what your key things you have to do to be successful are. A lot of this, it's fine, and I expect it to be continue to prove the thesis for your business. So, for example, if you have if you still need to get customers, a milestone can be signing the first customer. If you still need to finish building your product or hiring a CTO, those are perfectly good milestones. Let's see, have any contracts that you have and any partners that you have. So from time to time, we run into scenarios where somebody has done something kind of silly, like they've made a loan to their company and the loan has kind of weird terms on it or something like that. Eventually, you can assume that due diligence will find all of those documents. You might as well just bring them up front in the beginning. I have absolutely seen this sink deals where a founder made a loan to the company and expects to have the loan paid back in some future funding round. That basically never, ever happens, and we will almost never, ever invest in a financial situation that has that, or a company that has that. So have any contracts that you have signed, have them easily available. We'll take a look at them, make sure they're okay. If you rely on any partners for product development, I think that's fine. But again, like I said before, make sure you have somebody who can sort of vouch for that partner, and make sure you have somebody who can manage that partner on your team. We will, it may vary. It may vary a little bit how important that is. Sometimes you'll have a go-to-market partner. That may be fine. It may be normal for your industry. But again, have all those relationships in place. And then if you have existing corporate relationships, existing investors, super important. I always want to talk to a previous investor. Because they're, why did they invest, right? What was their passion about? How did they get involved in it? So have investors, advisors, any corporate relationships that you already have those available for us to review and take a quick look at. And really, after an hour, probably 20 minutes longer than I wanted to go, I feel like I've covered all of the major sections, and I'm happy to do more Q&A. this section here again is really about just become prepared, basically, right? So don't make us wait 2 weeks to find a contract or find a partner relationship. Again, have that stuff just ready to go in the deal room. Once you've done 2 or 3 of these, and in all likelihood, you may go through more than one due diligence, even in an angel round. Have all this stuff in a Google Doc or in a way where you can upload it to a Google document really quickly and easily.
So there's an amazing difference of experience from the investor point of view when people, you say, I would like this piece of information, and then they send you in the next hour a bunch of information rather than they say, oh, I'll get, and 2 weeks later it comes, right? What does that signal to you as an investor?
Yeah, so obviously, if they're organized in the way they run their due diligence, they're probably organized in the way they run their business, and that's a positive. So, and folks that come to due diligence and it's happenstash and all over the place, I suspect that that's also how they run their business, and that's not always what I'm looking to invest in. So,
again, back to quality of team and quality of execution.
Yep.
Are there other questions that people want to ask?
Oh my gosh, that's a big question. I'm going to take a second just to read it all. I would need to probably take this offline and have a more detailed conversation with you. Cap table math can be a little funky. B, it's I think John pointed this out earlier. We'd like to know who makes the decisions when there's split equity scenarios, right? So if you have 4 founders, with equal portions, you can get to a situation where literally nobody can make a decision, right? You could have 2 people voting for a deal and 2 people voting against the deal, and essentially you can't make that decision. So we do look for either odd number of founders or odd number of equity amounts. Not so much because we think that's the way it has to be, but because in practical terms, we want to know who makes the final decision on a major corporate event like a funding. And then the other details on that, I think I'm happy to do a call with you or set up a chime or something. And if you want to look specifically at your cap table, I can tell you what my thoughts on it are.
Cool. So you would like to have hard decisions that have to happen fast, be clear who's going to make that decision so that they can happen fast.
Yeah. So, I would love to see 3 founders, and it's okay actually if all 3 founders have 20%, because hey, any 2 of them, or if they each have 30%, any 2 of the founders can agree and make a decision, right? If you can't get at least 2 of the founders to agree, possibly it's not a good decision anyway, right? So,
yeah. So, how are people able to find you, or how are they able to arrange with you to do more follow-up?
So I'll put my email in the chat, and it's actually pretty easy. It's just stevehord@gmail. And generally speaking, I'm pretty available for coffees. It's a little harder to do coffees now, but I'll do virtual coffees with anybody who has any detailed questions. I think the best thing to do is if you have a specific scenario, like I think somebody wanted to do the, look at a cap table, shoot me the cap table. I'll take a quick look. And then I think we can just meet over Slack or something, or over the video conferencing tool of your choice, since I seem to have them all now. And I'm happy to give you my opinion. I do say that with a little caveat emptor that not every angel investor works the same way. So walk away from this with one thing in mind, which is that these are my priorities. And I think I share these priorities with a lot of other angel investors, but not every angel investor emphasizes unit economics in the way I emphasize unit economics. Not every angel investor, emphasizes the financial model the way I emphasize it. So I think as an investor or as a founder, I would say one of the most important things to know is do your due diligence on your investors, just like your investors are doing due diligence on you. Understand both what you're selling, but understand who you're selling it to, and take the time to customize for that particular angel group, because and once you understand what their emphasis is going to be, it can go a lot easier if you already have focused on that.
So angels are investing their own money. So there's as many angel opinions as there are angels.
Yes.
And so
absolutely,
this is very idiosyncratic.
Yep.
I see a question from Jacob about expertise from advisory board. What do you typically see for equity stake for advisory boards? I would bring up the advisory document from the Founders Institute. I'll go look that up. Do you have other opinions?
Yeah,
about
rarely
that?
more than 1 or 2%. I mean, advisors are sort of nice to have, right? If you have a very specific advisor, and every so often I'll see somebody who has a very specific advisor who is clearly either a customer or has a really direct path to helping make sales. And I'll value that advisor a little bit. But if it's just an industry advisor or a professor from UW who has expertise in a particular area, an advisor, we're not investing in the advisor, right? To be honest with you, right? So don't overpay for a little bit of window dressing, because it won't swing a deal one way or the other.
So the special suite deal with someone that's going to open a market for them for 60% of equity is an automatic no.
Yeah.
Right?
So no special suite deals, and really advisors are sort of. I say this, and I advise some companies that don't pay me, right? And I tell them that my advice is worth exactly what they've paid me for it. And so I think we discount that a little bit. It's great to have, and I think if you should have some advisors if you have some industry-specific advisors, and really if you have advisor very specifically that can open up a market for you, or that's an opportunity, right? If you have an advisor who can deliver a particular customer, then we want to make sure that that we know about it. But other than that, keep it single digits, or even half a digit or a quarter of a digit kind of numbers.
Right. Yusuf, you want to turn on your mic? No. Yusuf had his hand raised. I made him a speaker.
Okay, sorry.
There he is.
I guess
All
I
right.
had left my hand raised from that previous question on cap table stuff. So, Stephen, I'm sending you an email right now to discuss further, unless you guys want to make a more public chat about it.
That's up to you. How private is it? That's up to you.
No, I mean, I'd love to, I'm happy to get other people's opinions as well. So, basically, I have 3 co-founders in Poland right now, and the way we're bootstrapping our startup is we're using the profits from their software development firm that they've started.
Really common.
Yeah. So the situation is this: they had an initial angel investor in their software house, and so on our cap table we have, me with 17%, and then them with, and then a Polish entity with 83%. Right. And so I've taken that to firms, and I've gotten some pushback on that. You're gonna because
direct feedback that's going to be a problem, I think.
Yeah, that's going to be okay. And so we're planning. Sorry, I should let you talk actually.
Yeah. So I think there's actually 2 problems there, and this is super common, and it absolutely sank a company that I think should have won a SAC deal a couple years ago. A company came that had operations where all of the founders of the company were officers in a social media company, but like a digital marketing company, basically, right? They all had day jobs at their digital marketing company, and they were officers, right? So they were directors and I think maybe even the VP of something at the digital marketing company. And they were basically using revenue from the digital marketing company to help fund some of their product development. And it was unclear it was unclear to the due diligence team what the relationship was going to be between the new company, right, and the digital marketing company, right? And there was frankly just not a good answer for that. There was a lot of hand wave on that, and a lot of we'll maybe fold them together if one is successful or not successful, or if this other company is really successful, we'll spin it out. And because they didn't have a really clear story on that, quite a few members of the due diligence team essentially sort of walked away. So for the development portion of the company, I would much prefer that you just, that you figure out, have a really good story for how that revenue is going to be used and whether or not you're going to live off the services revenue. And then what ultimately happens is, because none of us want to invest in services company. I shouldn't say this. No, this is not true. I won't invest in services companies, right? So somebody out there will invest in services companies. I won't, generally speaking, invest in services companies because of the relatively lower margins, right, and the problem scaling them. And so if I suspect that your employees are going to spend all of their time, working on services engagements just to keep the lights on, just literally to keep the lights on, then I'm like, well, hey, how is my $200,000 being spent? Is it being spent well? Is it really going towards product development, or is it just, putting beer in the fridge, basically, right? And so that's your first problem. Your second problem is dead weight on a cap table and dead weight, if it's a lot of dead weight on a cap table, that's almost always a no-go, right? So we want to invest in the team. We want the team fully invested in the product and in the vision, and you won't get an angel investment because you'll never get a VC investment with a cap table that looks like that. So.
Yeah, got you. No,
and when he says that he wants the team invested, he wants them to win when you get to the end of the story and you get to the final line and everybody walks away with enough cash to be happy, right?
Yeah.
Right. So I'm going to take you off,
Thank you.
Yusuf, and then we're going to go back to another question. So, Steve, we see that angels or founders often spend a lot of time with optionality, right? Here's my plan A, here's my plan B. I'm going to do an IPO, but I'm going to get acquired by this guy. I'm going to hire this guy, but I have these other three guys. How do I deal with optionality on one hand and the ability to tell a cogent single story on the other?
So I think I see this from time to time, and I brought it up as an example earlier. I think most importantly, tell what you think is your best story, right? So
tell one good story with
right.
one thread.
Don't.
Right. So I'm either going to jump off the bridge or I'm going to cross the bridge, but I'm not going to do both.
Right. And there are exceptions to that. And I used one of the examples earlier, which is that, and I thought this was okay at the time he did it, which was that it wasn't clear what the best sales channel was going to be. And at some point he said, when we get past X dollars in sales, we're going to review this again, and we're going to either add or pivot to a different sales model. And he had obviously projections for both, what he thought was projection for both. One, mainly because the cost of goods, the cost of sales are different in those two models. But that's it. I mean, nothing more complicated than that. Tell the story based on what you think your best plan is going to be. And we understand you may pivot, right? The CTO may walk off the company at year 2, and you need to create a new CTO, or the customer you thought you had nailed, the customer profile you thought you had nailed is actually really different for you, and that happens, and we'll support that, but we don't need to talk about it at this stage, right? That's stuff that will happen in the future. So,
right. So at this point, I'd like to thank you. Thanks so much for doing this. I think it was great. I hope we're going to break up into tables and mingle. Steve, I'd like you to unshare your screen and turn on your mute. And then I'm going to invite Bob Crimmins up so that he can talk a little bit. So our program, Seattle Angel Conference, has been going now for 9 years. Bob Crimmins has been our MC for all of the angel conferences so far. He runs a thing called Startup Haven. Startup Haven is doing some new activities. Can you talk a little bit about that, Bob? Bob, you are on mute.
Aha. Sorry about that. Thank you, John. Well, thank you very much. And I just want to say first, Steve, that was terrific information. Really, really valuable. And for the record, Steve is a Startup Haven member, longtime Startup Haven member as well. Yeah, so Startup Haven is a membership organization for venture scale founders and investors. We've been around for 14 years. And we recently, in addition to a number of things that we've done over the years and some new things we're doing, one of those things is an accelerator. It's called the Groundwork Accelerator. And based on some of the comments I saw in the chat and some of the observations that Steve was making, I just wanted to put out there that the Groundwork Accelerator, we focus a lot on modeling assumptions, and we do that with spreadsheets. And when you come out of the Groundwork Accelerator, you can wrap and you can model almost anything that you care to model. And that the reason that we focus on that partly is because, first of all, you should know where you're going and how you're going to get there, and to be able to tell a cogent story for yourself and your team. But also in terms of raising capital, the exercise of diligence by an investor is effectively reverse engineering your story to see if it's cogent. To Steve's point, some investors, for some investors, that will mean spreadsheets. There'll be other approaches to diligence and figuring out, gosh, can you really get to that number in that amount of time with that team and those resources and that market that big and so forth. We think that financial or quantitative modeling for those assumptions is really important. So the Groundwork Accelerator, it's a three to 4 month program, and applications are open now. We just graduated our first cohort last month. And we'll be bringing on a new cohort soon. So if you're interested, feel free to reach out to me, Bob at startuphaven.com. Go to startuphaven.com. You'll find the Groundwork Accelerator there. You can learn more. Thank you, John, for giving me the opportunity to share that. And for everybody who's going to participate in the Seattle Angel Conference, I look forward to seeing you on conference day and getting to know you along the way as well.
Cool. Thank you, Bob. So now we're going to do mingling at the tables. You can chat with Bob about things. You can chat with Steve about things. We have several investors at the table that you can ask questions of. And please go to the meetup group and look at our future workshops. There are several more workshops that I think worth your attention. Thanks very much.